Hi, everyone. It's us again. Welcome to the Policy Exchange podcast. I'm delighted to be here with our two economics experts that you've heard from before for more insightful conversation about the state of the British economy. I'm here with Ruth Kelly, former Secretary of State for Transport, and Gerard Lyons, leading economist and former advisor to Boris Johnson. We have seen kind of almost an unprecedented week in British economic policy. We have a new Chancellor, the new Chancellor, Jeremy Hunt, was forced to make quite a remarkable statement on Monday about the state of the economy and announced a significant reversal of the UK government's mini-budget, significant rise in taxation, or a reversal of a number of tax cuts announced in that mini-budget. And my first question to Gerard and Ruth is really, why did the new Chancellor feel he needed to make this statement, and what was he trying to achieve in doing so on Monday, so early in the morning too, which I think was really remarkable before Parliament was sitting? I'll go to Gerard first, and then Ruth will get your thoughts.
Okay, well, Chancellor Hunt's comments, yes, they need to be seen in the context of the last few weeks. And in answer to your question, he was aiming his policy primarily at the financial markets. And the aim was to restore stability and to reassure markets about, in his mind, economic policy in the UK. Now, to put this in context, we've criticised the mini-budget here before. The mini-budget a few weeks ago, in many respects, focused on the general public through the energy cap and on the business community with its growth plan, and was well received, for instance, by the CBI, the IOD, and the Federation of Small Businesses. What the mini-budget of Kwasi Kwarteng failed to do was to address the fears of the financial markets. The mini-budget went far further than anyone expected. Initially, it was supposed to just be a fiscal event. It failed to assuage fears about the independence of the institutions, and it failed to outline fiscal discipline in terms of outlining the Chancellor's fiscal plans. So as a result, we had a very difficult last few weeks. Should be said, it wasn't just the mini-budget. The global backdrop has been very difficult, interest rates and inflation rising globally. The Bank of England was seen ahead of that mini-budget by the markets as being behind the curve. But on top of that, the mini-budget really added the risk premium to UK assets. So that created the backdrop by which Kwasi Kwarteng was replaced. So Chancellor Hunt was primarily aimed at addressing the fears of the financial markets and this idea of closing the black hole that we might talk about in a moment. So it's a pretty tough fiscal stance.
Sure, thank you. Ruth, do you have anything to add to that?
Well, it certainly failed. Trustonomics is dead now. And I think that the Prime Minister was forced into this position largely, actually, because of the risk to financial stability, which, as Larry Summers, who's a former Treasury Secretary, has described, has caused tremors around the world and actually risks creating a financial earthquake if we're not careful. So I think she had to act to stabilise the financial markets. On top of that, she also had to then restore credibility to our institutional policy making. People had completely, the markets in particular, had completely lost faith in the government's rationality in the formation of economic policy making. Mark Carney has described the approach as undercutting our economic institutions. And I think there was an element of truth to that, to announce a largely unfunded tax package without any economic forecast, whether it's from the OBR or even from the Treasury itself, demands a great deal of faith, in the government's credibility, and that just wasn't there. So this package of measures was a complete about turn, trying to restore some credibility.
So this I think is a point I want to pick up on in my next question, which was that it is a complete about turn, both because it reverses a number of tax rises. It also, the Prime Minister had said previously that there won't be any spending cuts, but in fact, the new Chancellor, Jeremy Hunt, has clearly forecasted the fact that there will be significant financial restraint going forward, both in changing the energy price guarantee from April, and also likely departments will be asked to go further and farther than they had been previously. And I guess my question in this economic context, what do you think the macroeconomic effect will be of a significant fiscal retrenchment at the moment? Obviously, there's the financial stability element, but what do you think its impact will be on the real economy? I'll start with you, Ruth, and then go to Gerard.
Yeah, well, it's very unfortunate that we're at that situation. We were the only large economy at this point in time, or planning a fiscal retrenchment just a month ago, as it were, before the mini budget, and now it looks like we're going to have to go even further to restore credibility. The problem is credibility is lost in a moment and it's very difficult to regain. And the likelihood is that fiscal retrenchment now needs to be deeper than anyone would wish. So the macroeconomic environment, what's it going to do to the economy? Well, it's probably better than it was last week because it stabilised the markets, and long gilt yields at every length have dropped a little bit, but worse than they were before the mini budget. I think it's highly likely now that the UK will see a recession coming, and it has given away some of the tools that you might use to avert that.
And Gerard, anything to add?
Yeah, I agree with that. Coming back to what Ruth was saying, look, earlier this year, the UK was the only G7 country planning to tighten fiscal policy and raise taxes into a global downturn. Hence, the IMF and many others were very critical. Therefore, it made sense ahead of the mini budget to use fiscal policy to stabilise the economy. But it was vital, and indeed, I think we've criticised it ahead of the event, it was vital for that mini budget to stick to exactly what the markets had discounted. Basically, the energy levy and reversing the corporation tax and reversing national insurance. But on top of that, reassuring and convincing the markets about the fiscal discipline. What that mini budget did, though, was to go further, to actually cut the top rate of tax, to have these other tax changes that should have been in a fully costed budget, and then the case made for them. Once it went further than that, it basically added fuel to the fire that tax cuts were the centre of this whole Trussonomics, whereas they shouldn't have been. And therefore, what we had was ahead of the mini budget, the markets anyway felt that debt to GDP was set to rise for the next couple of years, either because there was already going to be a recession or because of preventative measures to offset that recession. What we had now in terms of judging the Hunt policies is that debt to GDP is very high in the UK. Now, it's still manageable, but what that high level of debt GDP does is make the fiscal outlook very sensitive to either interest rate moves or to growth. And that relationship between growth and interest rates becomes key. Now, what this fiscal budget does, I think, implies that we will have a recession. It's likely to be deep because we're moving from, and we'll probably come to this in a moment, I hope, we're coming from cheap money and a relatively relaxed fiscal stance in previous years to now a much tighter fiscal stance and likely a much tighter monetary stance. The good news for the UK economy is the labour market is healthy, but unfortunately unemployment is set to rise. Good news is that some people have high savings, but many people don't, and the cost of living crisis is going to hit very hard. So I just see the cost of living crisis already slowing the economy, and on top of that now we have a tighter monetary and a tighter fiscal policy with tax increases and austerity to follow, and I think that will hit the economy very hard and it will slow significantly, and I think a recession is inevitable.
Can I ask you to expand on the point you made there about a tightening monetary policy? The context of the mini budget was understood there was going to be significant tightening of monetary policy. Do you think the fiscal retrenchment will lead to a slightly less tight monetary policy? And what do you think the Bank of England will want to do now going forward, given the new fiscal stance?
Yeah, there's a number of different facets there. First, because Kwasi Kwarteng, when he was Chancellor, failed to heed the warning signs he was given ahead of the mini budget. He overstretched the mark, did too much, and as Ruth was touching on earlier, really lost the confidence of the markets. So we saw a risk premium attached to UK assets in recent weeks. Now, a large part of that risk premium has now been reversed, not fully reversed yet, because of the actions of Chancellor Hunt. So it's aimed at stability, but at the expense of economic growth. Of course, if economic growth is weak and the economy is in recession, that could blow the public finances out of the water anyway. So that's a difficult backdrop. But in answer to your question on rates, there's two parts really. First, that risk premium is being addressed. But the second part is that monetary policy has to tighten anyway. And that was inevitable, I would say, even ahead of the mini budget. Because the markets in recent weeks have been concerned about two things in the UK, basically fiscal policy and monetary policy. Fiscal policy in terms of the necessity, the affordability, and the inflationary aspects of fiscal policy. But in terms of monetary policy, the markets very much have felt that the Bank of England has been behind the curve. And since 2008, we have had cheap money in the UK and in the West. That's led markets to not price properly for risk. It's led to an inefficient allocation of capital. It's led to rampant asset price inflation. It's allowed more general inflation to pick up in the last year or so. So we're going to see much tighter monetary policy. It might not have to be as tight, maybe as some people feared a week or 2 weeks ago, but even after the Hunt policy, it's still inevitable that interest rates or policy interest rates will have to rise further.
Thanks. That's really helpful. Anything you'd like to add to that, Ruth?
Yes, I think that Gerard correctly points to the fact that there would have needed to be some global macro adjustment anyway, given the fact that inflation is worldwide, largely caused by the war in Ukraine, but also supply constraints following the COVID crisis. So there was going to be a really potentially quite dramatic adjustment from the era of low interest rates and quantitative easing that we've seen throughout the world, the developed economies in recent years. That made this adjustment particularly difficult, actually, because it was coming on the back of what was likely to be an increasing pressure on interest rates and monetary policy anyway. So I think there will have to be a correction, that the Bank of England will have to raise interest rates higher, and we're seeing that, of course, in the long-term gilt yields. The problem for them is that they were also planning to not only stop quantitative easing, but start quantitative tightening, so selling gilts into the market. And now, of course, that has become much, much more difficult to do, given the fragility of the financial markets and the fact that really people don't want to hold bonds, gilts in particular. And there is a very significant risk premium still in evidence. I mean, the risk premium has fallen, but it's still there. So this puts that whole programme of quantitative tightening on hold for the time being. So it's going to be very difficult days for the Bank of England too.
Thanks. I think difficult days all around. Thank you both for the really insightful and interesting conversation. And no doubt we will speak very soon indeed. Thanks very much.
Thank you.
Thank you.